Now we have Dr. Biju telling us where to invest, the different investment possibilities, and overview will be given now.
Yeah, thank you, Thomas, and KSOS for having me in this IC. So this is my topic. So I was thinking how to cover this, and I thought of just starting with a story, and I got the story from the unlikeliest of the source. That is from the Bible itself. Yeah, this is something which everybody knows. Jesus Christ was telling this story to his disciples, this parable of the talents. So you know about that merchant who went for a long journey, and to his 3 servants, the first servant he gave 5 talents, the second 2 talents, third 1 talent. So he came after a particular time. Time is not mentioned in Bible, but after a well-known research, it has been concluded that it is 6 years considering the Jewish economic cycle. So let us say 6 years. So then what the servant has done with the money. So this is what has done. The first servant has managed to double it. The second also has managed to double it. They were suitably rewarded. The third one, he said that he was very afraid that he will be losing his money. He was afraid of his master. So he wanted to put his money absolutely safe. He dug a hole in the ground and just put the talent there. So that is it. So the first 2 servants was rewarded handsomely. The third one, as said in the Bible, he was banished to a place of darkness where there was gnashing of teeth. Now, when I was teaching this in the Sunday school, they asked me, that was really unfair of God, After all, what he did was just to keep the money safe. So it could not have just punished him. Actually, I didn't know the answer that time, but now I know the answer. There was no punishment by the master. It was a self-inflicted punishment because by the time the third servant reaches his retirement, as Thomas has already told, now that 1 talent would have reached 1/4 its value after 20 years. Why? That is the punishment, because of inflation. So he would not have enough money even to pay his electricity bill. So he will be in darkness. Okay. So now we have got 4 investment lessons to learn from this parable. That's what I'm telling you. So let us say the time was 6 years. So the first 2 servants, doubling of the money. So this is the returns that they were, basically getting, 12%. How did we get that return? You apply that simple rule of 72. Just 72 divided by the interest rate gives the number of years which is needed to double the principal investment. So that gives 12% returns. So that is the first lesson. The investment need to beat inflation. Thomas was again telling that. And last 10-year average inflation rate in India was 6%. So you need to have some sort of investment which should beat that. Now just compare it to your average FD, which is about giving you a return of 7% now, doubles in 10 years, you are still not beating inflation. Okay. Second lesson, the time of investment, it has to be long term. Long term means that at least 6 years or above. Again, the 6 years time here in the second lesson. Third lesson, were the servants given the money equally? No. What Bible says is that to each according to his ability. So that is why the first servant, the master identified that he was the top performer. So he was allotted 62.5% of the amount. Okay, the second one, not that reliable, but okay, 25%. Third one, he was taking a risk. So he knew that there is a chance that he is going to lose the money. That is why he gave him only 12.5%. And this is what is referred to as asset allocation. Asset allocation is the cornerstone of investing. This means that distributing your investable surplus across the asset classes, such as equity, debt, gold, real estate, or even cash. The focus is that you are just balancing and reducing the risk through optimal diversification of your entire portfolio. In simple words, don't keep all your eggs in the same nest. That's it. And the fourth lesson, what did the master do on return? No, he just, took that 1 talent and gave it to the top performer. Okay, so that is about reassessment and reallocation of portfolio. So just go and have a relook at your portfolio, identify the non-performing assets, and reclassify. Okay, so that is about the asset allocation and all this is. Now these are our different investment options that we are having. So I will just talking about a few of them. Now this blue thing that you're seeing here, oh, the pointer is not here. Okay, that blue, okay. So this is the inflation line. Okay, so we are talking about all the type of investment which are giving you returns above that. That only matters. So the one which is giving you 7%, that can be taken as the first servant. There is only one guy here. That is the stock market. Okay, so it gives you on an average 7% above inflation. That is the minimum if you know how to invest it in properly. So it is about the first servant. The other ones, you can see the fixed deposit, the bonds, gold, real estate. So these probably you can take them as the second servant. So here they just managed to beat inflation. And then you have got, of course, third servant, that is your savings bank. Now many of you will be giving it in, keeping it in savings bank. But you can look at the return. It just gives you 3%, which is almost less than you are losing money there. So you can see that as the returns increase, the risk also increases. That is why you need asset allocation. You need to diversify. And there are a lot of things here which are given. There is no time for going into that, but these are also there. But we don't have time. Okay, these are other factors to consider when you are allocating. That is your short-term and long-term goals and your financial needs also. Now, regarding stocks, anyway, all of you know that stocks, it just means that there's a share or ownership of the company. Somebody buys it either during an initial public offer or from the market. If the company is doing well and if the guy is keeping the share, you get the returns in the form of dividends if the company is making profit. Again, if the company is making profit, the share price increases, and if we just sort of sell it in the market, you make a profit. So that is the return that you get from the stocks. On the other hand, if the company doesn't do well, then you make a loss if you sell it. So this is essentially what is stock. Now, the thing is that there are two ways of investing in equities. One is by direct investment. That is, you just open a demat and a trading account through a stock broker and get started. Now, this needs a lot of time and effort. You need to read a lot. You need to do stock screening, research of stocks. You need to listen to financial news, etc. So this is something which, a minuscule percentage of us will be doing. So the most of us, what we can do is the indirect investment. That is, you just give your money to a particular asset management company. So they will be collecting all this money, producing a large corpus. And they will be buying shares for you from a large portfolio, because there's a lot of money there. So these are your mutual fund managers. So these are basically you are giving to the mutual funds and they will be investing for you, and these are mutual funds. But problem, of course, then you need to give them commission. There are expenses, entry load, then fund management fees, etc. will be there. The second option would be to seek the service of portfolio managing services. They will be professionally investing your money in either mutual fund, shares, real estate, things like that. But as Prashop said, you have to select your portfolio management very intelligently. So these are the two methods. Now, if you look at the mutual fund, there's a whole variety of all these things. There is no time again to go through each and every one of this, but basically you can classify it into large caps, mid caps, small caps, depending upon the capital which is the wealth of the company. So basically you can say the large caps would be safer. Now, just go through this chart. This just shows the appreciation in percentage from 2016-2023 of a few companies. This is the graph of how the share of Reliance has gone. You can see that it has gone almost appreciated about 347% from 2016. However, for the last 1 year, there is some amount of negative returns. The same is the graph of the Infosys also. And on the other hand, you can see that the S Bank here, it has had a meteoric ride initially, but somebody who has invested in that has lost 90% of his money now. So, this is the vagaries of stock market. But just see how the Nifty 50 has fared. It has had a smooth rise here, almost giving you 157.4% of appreciation without much of a hiccups. So, you can ask, if Nifty 50 tracks the share price of the top 50 blue chip companies in India. So can somebody sort of buy all these companies for me? Sure, they can. So there are mutual funds like that which tracks the performance of these companies, and these are called index funds. So it's a very good option for people who are not very savvy about this index investing. It's a fail-safe strategy. How much equity should you invest in? Use the 100 minus age rule. It means that you should hold a percentage of stocks that is equal to 100 minus your age. If you are 40, you should hold 60% of your portfolio in stocks. The rest should be in debt and fixed income securities like that. And the way to invest in equity is by using SIPs or STPs. Again, there is no time you have to actually read up that. You don't have time to go in details. Now the other investment, so the FDs, lower time debt investments. FDs are these tax shelter deposit, these are things which everybody knows. But bonds are things which you are not very familiar with. This can actually give you a slightly more return than the FDs. So how do you invest in bonds? There are online sites like this. And by indirectly, you can also opt for debt, mutual funds and ETFs, etc. Real estate, of course, the liquidity problems is there, as Thomas was telling, but you can look at these things here. There are real estate investment trusts, then infrastructure investment trusts whose listed shares are available for you to purchase, and it gives you a good option, at the same time not wrapping your money. Gold has always been a protection against inflation and deflation, gives you reasonable returns, and it is something which gives you true diversification, which means that it goes sort of opposite to what the share market is going. Okay, so finally, now this is something. Now I haven't understood anything of this. I'm a novice, don't know stocks, don't know mutual funds, not ready to spend time researching them. I get confused when agents approach me with all sort of mutual fund investment scheme. I don't trust real estate. What should I do to get an annualized return of 12% per annum after investing for say 6 to 10 years? If you are somebody who is asking this question, then my personal answer is this. Start investing by putting your 110 minus age percentage of your investable amount in a Nifty 50 index fund on the 13th of every month. And the remaining FDs and gold. Why 13th and all? Probably we will discuss if I get the question. Thank you.
Yeah. Thank you, Biju. You kept it entertaining as well as very educative. Thank you, Biju.